Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you about the Pound Aussie pair and a few attributes about it. A lot of people overlook this pair because it's not one of your more common crosses, even though it involves two very common pairs, but just not people noticing them paired up together. They are on. This pair is on most trading stations now. It's possible it may not be on some, but it is on most of the major firms have it on their trading stations. And this pair is very volatile. For instance, over here on your scale, from here to here is 1,000 pips, from here to here is 1,000 pips, from here to here is 1,000 pips, etc. So, I mean, it's like, multiple thousands of pips here, over just what, a year and a half's time, from here to here. And it's an extremely trending pair, very directional. When it gets in one direction, it doesn't change very often. And then when it changes, it'll change pretty quickly and stay in that direction for quite some time. What you had here was the credit crisis. This pair tends to thrive and go up, particularly when stock markets do bad. And so you had the credit crunch and stocks, the Dow was headed for, the 6,000s and that sort of thing. And this is when this thing just went to the moon. When things started stabilizing a bit, it started tapering off some. And then it just fell, for just thousands of pips as the markets, financial markets stabilized and then trended upward. So that's the big picture on the daily chart, and I want to show you there's a few different ways you can use this. Since it is very trendy, very V-shaped, it's very much like pound yen, and people are very familiar with pound yen, but this is like pound yen 2.0 or pound yen on steroids or something like that, because it's a lot more volatile and even more trendy than pound yen. But what you can do is you can put a couple of near-term moving averages on it. These are EMAs, exponential moving averages here. See, if I use a moving average crossover system, a lot of times I will use EMAs. Most of the times, other than crossover systems, I use SMAs, simple moving averages. And unless I know a pair to be extremely trendy and extremely volatile, I usually don't do crossovers. But on things like pound yen, pound Aussie, things of that sort, I will use a crossover system from time to time. And this happens to be a 10 EMA, so 10 period exponential moving average and a 26 period exponential moving average. And you just simply buy when it crosses heading higher, and you sell short when it heads lower. Now, one thing I do want to point out is you get some of your best signals when in crossovers when the pair is not the moving averages rather are not real close together. But this one is volatile enough to where even when you catch short moves like this, you'll probably likely come out flat to a minor loss to a minor gain, somewhere in there, but usually not something that's run away from you. So it keeps you on the right side of the trend. It points the direction of the trend which you're just trading in the direction of these averages. When your shorter term average, which in this case is the black line, crosses the green line, the longer average, the 26 EMA, then you sell short, and you don't necessarily buy back until these lines cross, which they did not cross here. So you stay in it until they cross here. Now, with that said, once you start getting in the trade here and it drops a lot on you, I know traders are going to get skittish and think I've got to take profits. Instead of taking profits, one thing you might do on these very volatile trending pairs is move your stop from probably way back here somewhere, moving it part of the way into the profit, but leaving plenty of room for it to run, because as it makes another oscillation up and then start down again, you'll be able to move your stop down quite a bit more, protect more profits, etc., and allow this thing to move as it oscillates up again. Then you can move it on down. Since it immediately crosses back down, you could stay in the trade, or you may get triggered out once you see this happen here. If you do, that's fine. Now you can go short again once you see this thing dip back down below and head lower. So this is on a 4-hour chart, and it allows you to stay in trending moves for quite some time, because each one of these candles is it's 4-hour candle. So really, once it crosses and starts heading down, usually it will head down for quite some time. Now remember, the daily trend was down, so your down moves are probably going to be your biggest, longest moves and have the least amount of false breaks. Lately we've had some up moves, and who knows if we get another market crash on our hands, because the stock markets are getting pretty frothy right now. If that were to happen, then this up move is really going to have legs, and then most of your up move would be on most of your momentum and your longest moves then would be on the upside. And then for you scalpers out there, which again, I don't encourage scalping. It is probably your least profitable form of trading. You really need to be very good at what you do and on longer time frames before you go to shorter time frames, in my opinion. But this is a 5-day, 5-minute chart, and you can see from low to high here, this covered let's see, 4, 5, 6, probably 700 pips, it looks like, from low to high over 5-day period. So I'm talking about a pair that gets to smoking. So if you thrive on volatility and trendiness and an enormous amount of pips potential per day, Pound Aussie is your pair. Now on the shorter time frames, you'll want to zoom in on these and get these to looking quite a bit bigger so that you can really see the moving averages and what they're doing. But you'll see, if you go with the major trend, when it crosses on the short side, since the daily was short and the 4-hour was still headed down as well, you're going to get your bigger momentum moves there, because this was like 150, 200 pip move here on a 5-minute chart. I mean, it's amazing. Now your up move, up move here, let's take a look. Let's just go from the higher of the range to the lower of the range. You're looking at about 60 pips from there to there. If you were just simply observing the crossovers, you're looking at about 23 to 25 pips or so from cross to cross, even on the small moves. So even those moves are enough for a scalper that's looking for 5, 10, 15, 20 pips on a trade. But keep in mind, when you're with the main momentum, even on this pair, you can get ones that that go 50, 100, 150 pips or so in your favor. And and you'll see there's some big swings where this happens. So the pairs that have real V-shaped tops and bottoms, which are not many, most are fairly rounded, but pound in particular, not necessarily against the dollar, but say pound against the yen, pound against the Aussie, things of that sort, tends to V-shape, make these V-sharp turns, and those are very much the type of pairs and volatility that's good for a moving average crossover system. If you get a tame pair or a mild trending pair or a range trading pair, that's not going to be necessarily good and conducive for a crossover trading system. And that is the chart of the day. Thanks so much for watching.